All right, ladies and gentlemen, thank you very much for joining. So this is the first session after the lunch break. Hope you had a good one. And just to wake you up a bit, just wanted to ask a little question related to the topic. So who of you is in a startup and currently looking for money? There we go. So I see we got the right audience here, and I hope that we can help you answer a couple of questions. Because the topic is how to raise money, the essentials of a great pitch. We are from Axpo. I'm George, and this is my colleague Mario.
Hi.
And we both work in the ventures team, or we call ourselves partnering and investing. And we basically seek to put more startup into Axpo. And we're going to tell you a little bit also on how we do this. So Axpo is the largest electric utility in Switzerland, if you didn't know that, producing around 40% of the electricity consumed in Switzerland. And beyond Switzerland, we're active in renewables project development, like across the board. We do PV, solar, onshore wind, batteries, hydrogen, even hydrogen, as well as very much energy trading. So if you should have any cool idea in the realm of energy, and you work in a startup, please come to us. We would love to talk to you. What we do, that's basically me, Mario, and my colleague Felicia, who's sitting here, is Axpo is a beast of a company. We have 7,000 employees across a lot of different divisions, and all of them kind of do their thing and are heads down trying to solve the important challenges that they have. Now, what we do is we try to help them make the best decisions when it comes to startups. So we have a very regular and structured exchanges with them to understand the challenges that they have and to identify areas where a collaboration with startups would make sense to make things basically better, faster, and more pragmatically to come to a solution that works. So that also defines the startups that we look for. We look for late seed to Series A, B. So basically startups that already have a product that we can use at one of our businesses. And this is really what we do. We want to help our businesses to accelerate their growth, bring new perspectives, and put us on the map in the startup world, because actually our team has only been around for 3 years, so we are really quite new. You have to think in energy, the planning horizons is like 20 years or 30 years. When you build a power plant, so 3 years is really nothing. So this business here, we've seen around 1,000 startups. Seen means that we've looked into it, looked at the website, looked at the pitch decks, etc. Mostly in the DACH region, because as a Swiss company, obviously we have our roots here, but we do look to Switzerland and Europe, and obviously all of the companies are in the climate tech space, so we are very interested in finding anything innovative solutions in climate tech. So startup always 100% of the time equals growth. And to grow, you need the right team, obviously. You need a good idea that you can iterate on, and you need the capital. And this is what we're going to look into today. It's about the storytelling and the structure of how to approach the different sources of capital that you might have access to as a startup. Yeah. So giving over to Mario.
Thank you. So in an ideal world, probably you wouldn't need money to grow a successful business, but reality is that there is a need sort of to get some form of money, especially when you're pre-revenue. And I think this is the emphasis when you want to put today, sort of where can I look for money? That's like the first step into this. So you have a plethora of different vehicles, investors being active in that space, right? And I think the takeaway here, to give it up front, is do not shotgun your pitch, right? So think about what preferences different investors have. Think about what stages to invest in. Think about what angle that might have, right? We're going to take a bit of a deep dive here for the corporate investor and the VC. I think those are the ones that are most prominent, probably. But do not neglect accelerators and incubators, right? Because especially when you're starting out, you have your MVP, your program, you want to get some instant product feedback. And in order to get that instant product feedback, usually an accelerator, an incubator is a great place to start, especially if you're in B2B. If you're active in B2C, why not go for crowdfunding? You would also have instant customer feedback, whether that's accepted or not. Your product, basically, and obviously friends and family is always a viable option, as with many successful cases that we've seen in the past. So looking at a corporate investor, and I think we can speak sort of from that angle as corporates ourselves, is the positives are obviously the cash, but nowadays I think good startups look for so-called smart money. So you want something that goes along with that cash, right? So that could be a network, a validation of your product, and being able to engage with experts from the get-go, really, from the very first talks. Also use it as a shop window for M&A. Think about maybe your, estimating your exit options, possibilities, where do I see my business in 10 or 15 years? Place yourself as in accordance with that, right? And that's something what we look for. We always look for strategic fit. So if we go for an investment in a startup, we do have a strategic angle to that next to the financial return, obviously, right? Think about the market knowledge you could gain from a corporate investor, especially if you sort of are well aligned with your strategic investor. But then again, on the other side, obviously, the processes are slower. I mean, we give our best to sort of be fast on deals, right? Especially when VCs are involved, they sort of have a very agile teams. But then we have like legal that needs to review documents within a large corporation. We need the business to sort of have a saying. So it might take a while, but I think it's could be worth it. And often, obviously, the startup culture. Now here, I would say is what we see is make sure to interact with companies that already have a dedicated team or someone that runs ventures or innovation, just because making sure that the mindset within the corporation is there. So that would be like a small takeaway here, and obviously you have different example of large companies doing that. Yeah, looking at the VCs, I mean, basically, bottom line is a VC wants to make 10 francs out of 1 franc. So that's simply like a financial investment. Obviously, we see funds that have different stage focuses, different topic focuses. But that means there is one clear goal, and that's maximization of growth, obviously, right? So they want to sell the share that they have acquired at some point. And you kind of lose an independence. Remember, a corporate investor is patient capital. So we have time. You don't really need to sort of deliver hyper growth and make the largest IPO in the history. So there is a bit of a freedom when it comes to product development and scaling. And then obviously business angels, I think, are a great option, especially starting out thinking about investments up to 500K. Usually they'll get in at a lower valuation. That means a larger share, but still it's sort of a less structured approach from compared to a VC or a corporate, but nevertheless a viable one, because you might also get mentoring on context. Usually you have people that can afford to sort of do business angel deals, and that's usually successful people, and they have a network, they have a certain degree of experience to mentor you in and open doors. So that's obviously, I think, a good way as well. Now, let's talk about the different stages. I mean, this is basic founder knowledge, but I think what we're realizing is, people do often get like confused, and also when it comes to that shotgun approach of where do I look for investors. So you're starting out with a prototype, right? You might need a very small ticket, and then you could think about friends and family. You could think about an accelerator, join maybe an incubator, but this is not usually a stage where it's interesting for a VC or a corporate to get on your deal, right? That's a seed stage is something where you might be looking for up to $500,000. So where you just launched your MVP, so that's something that's at least minimally viable for us to have a look at. And even there, it's mostly VC, early stage, seed stage, or pre-seed VCs and corporates. Be aware. It could also be like we've seen, I think 2 weeks ago, we saw a 17 million seed round. So it necessarily, it doesn't have to be tied to that number that you're raising, but it's very much tied to the KPIs that you might need to deliver and the performance indices at back there. So as you know, a startup grows obviously, right, runs through different stages, and that focus area also changes depending on the sort of that startup age, if you like, right? So in the growth stage, for example, your product is already accepted and you sort of need a performance marketing and stuff like that. So you need a growth stage investor behind you with a lot of money, with a lot of cash to sort of fund that momentum. And once you're mature, obviously you've made it, then it's either an exit or an IPO, and the timing can obviously change. But I think, you know, more or less the takeaway here should be quite clear, I think. Now, also something to be aware of. I mean, you guys are all entrepreneurs, so you work basically trying to realize your dream, right? And being aware how much shares can sort of go away and how many and what percentage of that K table can sort of dilute is something to be aware of, right? So keep that in mind when looking for investors. You know, obviously a corporate investor. We also, at some point, we would be interested to gain control of the company, gain control of the technology. So that share might end up, you know, might start with 10% in a decent Series A round, might go to 100% at some point, right? So that's like the final goal. A VC would always probably stick to below 50 and try to resell that share. And then you have, as mentioned, you know, we also see accelerators taking shares, right? So they give you some form of mentoring, might give you a bit of a space and somewhere to work, open a few doors and give a very small ticket, and then take a few shares. So keep the shares in mind and do your research on shares. You know what's appropriate, how evaluation might look like, what's the deal size like, and what did that implicate for your total company valuation. And yeah, so maybe we can do a very quick sort of a quiz here if you like. So we have like a Danish smart meter startup that's focusing on exclusive properties. So they're raising money currently to further develop the product. And they need access to data sources in order to validate their model. And that's pretty much the only way to go. Find the data sources. And they expect to be break even in 2 years and have a capital need that's not as high, so it's just $500,000. And yeah, they're expected to be sort of to have a certain EBITDA potential of 3 to 5 million. They already generate revenues, very small ones. So what do you think? What would this be interesting for? Any ideas? Just quick shot ideas maybe.
Yeah.
And why? Yeah, something there.
I'd say it'd be interesting for a business angel because they can get information to perfect their product.
Yeah, for sure. I think, at least my perspective, I'm interested to hear Georg's perspective as well. So I would say business angel, someone maybe with a background in the industry, with a strong network and door opening capabilities, and maybe an early stage CVC arm of a company that might provide those data sources. So
yeah, I'd also say, not interesting for VC because the upside is not big enough. So even if you get in cheap, it's not really worth it for a VC if you end up at 3 to 5 million EBITDA. So that would lead to a corporate venture capital or a business angels.
Indeed. So hopefully you've gotten the idea, but happy to expand on this then in the Q&A. And yeah, now I think we can have a look at how to raise money, sort of, and how that process looks like in a day-to-day.
Yeah. So it takes a lot of time and it takes a lot of effort. I've heard at one point that to get kind of the first positive answers, you need on average to send 30, 40 requests out when you're fundraising, especially for the first time. And it's a very steep learning curve. So that's very important from a mindset perspective, is you need to be prepared that you're going to get much more no's than you're going to get yeses, even if you have a great pitch and everything looks great. And then it's maybe not a full-time job, but it will take the majority of time of a CEO of a startup, of the founder, while he's in the fundraising process. So if your team is still small, that means that you have to put a lot of stuff on hold. For example, pushing the sales or developing your product further or whatever you're focusing on. You will have to focus on getting the money so you can continue to do what you actually love. So what's very important is to scope your fundraising right. So if you say have a cash burn of 500,000 per year, and then you raise just 300,000, probably not great, because basically you end the fundraising and you will have to start another one right again. So you will ideally have a financing round that gives you a runway of around 18 to 24 months. So you can raise the capital and then for, say, 12 to 18 months, fully focus on growing the business, on bringing it to the next level. For example, to bring it from seed stage to Series A stage, where you really establish the product market fit. It takes a lot of time, takes a lot of effort. And if you size the round too small, then that's bad. Instead, if you size the round too big and you collect 5 million on a 500,000 burn rate and you have VCs in there, they will want you to gamble it all. They will say, okay, I have 20 companies in my portfolio. So if you go bankrupt, basically, I don't care so much because I will have 19 others. So they will always push you to go all in if you have too much capital lying around and will want you to try to achieve growth faster, which might not be in your interest because you usually don't have 20 companies running at the same time, but instead all of your eggs are in that one basket. So you got to be careful about that. Yeah. This is a bit of a creepy map, but it's actually not so complicated. So actually Mario said the shotgun approach is not the greatest, or like throw a lot of spaghetti on the wall and see what sticks. Not the best approach for fundraising. I think it really makes a lot of sense to think about what type of smartness in the money you want to have in your cap table, and then really go out in the market and look for the right type of investors that could provide this. And so you do not have to get 50 no's in order to get a first yes, but you go directly more structured and more targeted in looking for who could be your next investor. Now, obviously, it's a two-way street. And investors that you approach, and they will see that you did your homework, and you can tell them the reasons why your company is interesting for them, for example, because they have similar companies in their portfolio, they will appreciate it. And that will definitely be a point on the plus side. So make the list of investors. Have a good pitch deck. Doesn't need to look great. We have a couple of examples later on in the presentation of big companies that started small. The pitch deck looks quite shitty, but it's straightforward. So that's the most important part. You work 24/7 on your startup, and you are 100% thinking of that all the time. You send it to an investor, he probably gets 5 pitch decks per day, and he will spend a couple of minutes on your thing. If he doesn't understand it, it will go in the discard pile. So it needs to be very straightforward, even if the thing that you're doing is probably a lot more complex. So list of investors, really do your homework in this. An easy to understand pitch deck that's straightforward and addresses the classical points. We're going to address that. Follow up, but be a pain in the ass, but not too much. So give it a bit of space, give it 5 days, 7 days, then you can follow up. Don't directly chase. You might be the one that checks the email inbox 20 times per day to see, like, is the reply there yet? Be patient, because you need to follow up, but not too much. Very important, before meeting, prep. So that's something where friends and family come in handy, even more so than as investors, to really help you prepare and think of the uncomfortable questions that might come. Then, obviously, you did your homework, you got a meeting, you're there, you're fully confident, and present your stuff. And then you don't hear back for 2 weeks, and you say, what's this? Doesn't mean a lot. Give it a bit of time. Give it 1-2 weeks until you follow up. And very important is also to keep track of what you actually are doing, because at some point the numbers will grow a bit bigger of the parties that you contact. So it's important to kind of have a customer relationship management tool on your side if you want, so that also when the next financing round comes, because there's always the next financing round, you know who you were in contact with, you can follow up and build on your network that you've cultivated in this way. So basically it's like dating. Sometimes it just clicks in the first meeting, and you might even get a first commitment to financing during the meeting. Most of the times, it's probably not that way. But if you really don't hear back after even you chase, it's probably no, and the investors just try to say it. Now, talking about the pitch deck, so it's really meant to give somebody that's never heard about your company a good idea of what problem you're trying to solve and how you're going to solve it in which market, so and with which team. I guess these are the most important things. And basically, it's always the same type of slides that are in this order, on a different order. You always find the same slides in any pitch deck. So you'll find what's really the purpose, what's the problem, what's the solution, the urgency, so why is it now? There are countless examples of companies that had a great idea to solve a really relevant problem, but it was just the wrong time, it was 5 years early, 10 years early, etc. What's the market size? So if you're active in a very fast-growing market, it's actually good enough to swim with the market growth, to already have an okay business plan, and then if you have credible arguments why you will grow faster than the market, then that makes it quite easy to argue why it's a good case. What's the competitors, the products, how do you earn money? So that's really the business model. What's the team, and then bottom line, what's the financials? You want to go next?
Yeah, sure. So just to visualize that. So you see here the template, right? And you see two different pitch decks from companies that are quite old now, right? So successful businesses. But I think it's their simplicity that is like something to keep in mind, right? So it doesn't have to be one-to-one as Sequoia says so. So there are different approaches, but the high-level idea needs to be there. Of your, so I like to think of a pitch deck as a movie trailer. So that's what you sort of present us, and within a first meeting or after a first meeting, right? But you can always have the ability to do a bit of a deep dive, right? But the categories, they're always there, right? So looking at YouTube, I mean, this might look a bit funny and silly now in 2025, but this is how their problem and solution slide look like, right? There is no fuzz and it's to the point. Right, videos.
And you think in 25 you can't do this? Instead, last year there was a French startup that raised a couple of million on a 2-page Word document. So it doesn't need to look fancy. It's really about the content.
Yeah. So you see, video files are too large to email, and you go like, okay, yeah, that's true, right? So it sort of fits that criteria, right? And you also have the solution directly. So it's very clear, it's very simple, and it's pure. And that's also, I think, what we appreciate when looking at pitch decks. It doesn't have to be full of sort of buzzwords and all that noise around there and long sentences and adding those flavors. Doesn't have to be that way. Just keep it very clear. Or here, when it comes to like the market size, Airbnb, a very, very visual and yet simple approach, right? So what's like your total available market? There you go. You visualize sort of the share that you can gain out of that, and it just makes sense. You know, how much could you earn from trips via Airbnb, and that's your sum, or market share basically that's serviceable. And then at the business model, I like this one a lot because oftentimes I think that's maybe it's an energy thing, but oftentimes we ask ourselves, how do you make money? And here it's like we take a 10% commission on each transaction. Okay, so they take a commission on a transaction. Well, how many transactions can they cover? That's the second question, and they have it here, right? So you have the total trips via Airbnb. It's an average fee of $20. And then you come to your potential revenue. Just put it into perspective. I think that's a very, very important part in that. You know, being able to visualize how much market share you can gain and how much of that sort of breaks down and how your business model looks like. You know, yeah, maybe just to sort of wrap up all those inputs before getting into the Q&A is like what are the 12 golden rules that we see? So first of all, it's basic, but yet again, you can never say it often enough. It's like check the spelling and don't be mysterious. I mean, on a few instances, you know, startups have asked for NDA to tell the name. It's not the way to sort of that works. Just don't be as mysterious. Communicate clearly, and don't make it necessarily complicated, just so it sounds complex and everyone goes like, "Wow." I think being clear and it definitely helps a lot. And also, as Georg mentioned earlier, look at the portfolio, you know, look at the scope, look at what VCs are investing in. Do they have like dedicated verticals that they look into? When it comes to CVCs, look at the corporation, you know, what do we state? What is our so-called sweet spot when it comes to both ticket sizes and topics that we want to cover? So that's very, very important, having a look at the portfolio. Maybe you're competitive with the company, right? So the chances are probably not that high that you might get into a second round with a VC in this case. Try to explain in one sentence, as visualized with Airbnb, and do not underestimate the funding need, and that one correlates also with number 6. So try to solve a big problem, try to visualize that big problem, and do not estimate the funding need, right? So make sure that your funding need corresponds to your burn rate and the cash that you are going to be spending. And then 7 and 8, you know, get your data right, be responsive. I think that's just something that should be sort of natural. Doesn't really need that much of a repeatment. And do not push too hard. Start a conversation, make an impression, and number 12, I don't know if you covered that in the process, but have a techie on board. That usually helps a lot. Also, we do like to take people from the business sometimes when startups are pitching, and it will get very, very detailed, right? So having someone that is able to answer those questions, I think that makes a hell of a first impression. Yeah. And yeah, so this is basically us. Feel free to reach out if you have a conversation. If you have an energy tech startup, sort of feel free to also get in touch with us. As Georg mentioned, we usually do late seed to Series B, but as also seen today, you know, it's always good to keep in touch and connect and network. And if a pilot is not a fit or the funding need is not a fit, we might see each other again in 2 or 3 years. So we like to think in longer cycles. And with that, yeah, happy to have some questions, if any. Yeah.
There needs to be a microphone because it's recorded. Yeah. So be careful what you say.
I did not know that you are interested in energy companies, because I thought it's advisors who want to advise about the ideal pitch. We are a food tech startup, so we're way away from your energy demand. We have all these aspects, what you mentioned, in the pitch. So our pitch is totally complete. So I would like a hint from you. You know, maybe we can discuss afterwards. I'll show you the pitch deck. What is your impression? Where we need improving in our pitch? Yeah.
Yeah, I'd be happy to take a look. Sure.
Okay, great.
Yes.
Can I ask a question about, say, the team size?
Yes.
Okay? I mean, in the early stage, it's not that you have all of the functions which a company would have, you know. So, what numbers are you looking there? So I get there a little bit of mixed message. So sometimes I hear there has to be at least 3 names, 3 positions there. Sometimes it's less. So what is this? The number, you know, where you feel comfortable and say, okay, that makes sense. This is an early startup. 2 people is fine. Or is it really that, you know, you want to see the complete team? So what is your take on that?
It completely depends on the stage. So if you have the typical, say, ETH, EPFL spin-off pre-seed that come fresh out of their doctoral thesis or something like that, you will usually have 2 or 3 people that are very much experts in what they do. And now, for a company like this, we don't invest in that. It's too early for us. What I, as an angel investor, would look at is, do they have complementary skill sets? And for example, if it's 3 engineers, do they recognize that they're missing the business element? And do they say that and say like, hey, look, with the pre-seed money, we would get a business guy, for example, on board to help us set up the supply chain or the sales team or whatever. Then when you come to late seed or Series A, you would expect a kind of full-fledged team, maybe with 1 to open positions. So full-fledged in a startup is maybe 7 to 10 people, 7 to 12 people. So you have more of a specialization. I'm aware that at startups everybody does everything, but you still kind of need a bit responsibilities for the different domains. You would expect, 7 to 12 people for Series A, can go up to 50 depending on the company, how far along it is. And then as you grow along the stages, it can get basically to any size. I think what's always important is that you have a good mix. So we, for example, prefer diverse teams. So if you have a team composed of just guys and you have a mixed team, we would prefer the mixed team if everything else is equal. No? So diversity, I think, is important, and even more important is a complementarity of experiences and of profiles, so that you don't have 3 times the same profile that did the same PhD together in one startup that are not aware that there might be aspects that are missing to the team.
Okay, thanks.
Yeah.
So you're doing both partnering and investing. How do you decide when you just partner or when you do also investing?
Yeah, so for as we're set up right now, pretty much the companies that we invest in would also be strategic partners to our business, because we look for companies that have solutions that we can use within the company, within Axpo, to work together with them. Now, how do we decide whether to invest or not? Is really it's 2 questions. It's like, do we add value for Axpo by being a shareholder in the company? So, for example, if we are a shareholder in the company and say hold 20%, can we do things that otherwise we could not if we were a pure commercial partner? For example, help them really open the doors of our clients, which we probably would not do to a pure partner, or help them really finish the development of a product. So stuff where we really add a lot of value that otherwise we wouldn't do, we would say, okay, so we need an equity investment. And on the other side, it also needs to make sense for the startup to have Axpo on their cap table. So there are cases in which it doesn't make sense because we're a strategic investor. So with a strategic investor in the cap table, it also blocks you a couple of avenues. No? For example, if Axpo would be a 20% investor, would it make it more difficult for the startup to then work with other energy utilities, or would it make it easier? Like, would they see that as a threat, for example? So it needs to fit in both ways. So it needs to add value for Axpo, and it needs to add value for the startup, and then we consider it.
Thank you.
So I have a question, because you said that you are investing kind of late. I mean, in a Series A, right? Series B stage. So if a startup have a CVC on board already before you, it can make difficult for Axpo to actually invest if the CVC already there. I mean, it's already aligning the strategy a bit of the company, of the startup, and so on, is in the board. So how do you manage this? Or, I mean, and also, why are you investing maybe so late and not on the seed or pre-seed?
Yeah, so we have actually done co-investments with other CVCs or with other strategic corporate investors. So as long as we like the other corporate, that's not a problem. If it's a direct competitor, it's probably not the ideal scenario. Now, why do we invest in late seed, Series A, Series B? It's because it's less risky, as simple as that. So as you move along the stages, you decrease or remove certain risks, like from pre-seed to seed. There's usually some technical risk, for example, that falls away. So from seed to Series A, you would have the first revenue, so you would have a first indicator, at least for product market fit. So it reduces the risk, And with the number of investments that we want to do, it wouldn't make sense to make seed investments. Or put it different, if we were to do seed investments, rather than doing 2-3 investments per year, we should probably be doing 8 to 10 investments per year in order to get a risk profile that makes sense from a portfolio perspective.
Thank you.
Thank you. I just want to know, is your investment limited to local startups, or you also consider global
We
startups?
consider, I would say, anything on continental Europe, because that's where sort of the lion's share of our business is when it comes to the different business areas that we have. But generally, I mean, when it comes to piloting or technology, doesn't really know any borders nowadays. So it's very global. We do look at U.S. startups, for example, as something where we sometimes might look into. But generally, I think, at least for the investment part, so it's Swiss and European, if you like, continental Europe. So that's a bit our scope, yeah.
All right. Looking outside continues to be nice.
Yeah.
So
It's very sunny.
hope you find a nice next session, or otherwise go out and enjoy the coffee. It's excellent. And have a good startup days.
Yeah.
Thank you.
Thank you.